Hey, Vision Chasers, Dr. Bird here. Recently in the news, I came across something that reminded me of one of the causes of the Great Depression. And we know that the Great Depression was a time of suffering for many, many Americans. And I did a video about the causes of the Great Depression, and I encourage you to check that out. But more specifically, during the beginning of the Great Depression, there were a lot of what are known as bank runs. Bank runs. Now check this out right here. What you see is a number of people trying to get into their bank. A number of people trying to get into their bank. Now, what I want to do is I want to just give you a quick rundown when we talk about banks and or other financial institutions. Their job is to make money. Their job is to make money, and primarily banks make money by lending money out. Once again, banks make money by lending money out. Now, when people buy big ticket items such as, let's say, a house, okay, they're very expensive, and typically normal everyday people, we just don't have the money to pay for a house up front with cash. And so what happens is people will go to the bank. The bank will give a loan, otherwise known as a mortgage, for the house. They'll give a loan, and then as the years go by, the person makes payments on that loan, and they get to stay in the house. They get to decorate the house, make the house their own, as long as they're making payments on the loan. And it works like this. Let's keep it really simple. Let's say the house costs $100. So Joe Smith goes to American Union Bank and says, "Hey, I'd like to borrow $100 to buy this house." So he borrows $100, and they set the terms of the agreement. Let's say it's a 10-year loan, okay? And so at the end of that 10 years, Joe Smith will have paid the bank $130. $130. Well, remember that. Let's go back to the beginning. He took out a loan for $100 to purchase a house, but in the end, when you add up all the payments, he's paying $130 back to the bank. What's that $30? Well, that $30 is what's called interest. That is the cost of taking out the loan from the bank. And that $30, that's how banks make money. Now, banks, what they like to do is they make money by lending money out. The money that people put in the bank for their savings account, for their checking account. The bank says, "Yeah, we've got this. This is nice and safe over here." But in reality, what they do is they'll take some of that and they'll lend it out here, 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 and here. Now, ideally, what the banks are supposed to do is they're supposed to make sure that they have enough cash on hand just in case, people who have checking accounts, if they want to spend some money, or if, they have an emergency and they need to take a bunch of their money out, banks should be ready just in case something like that happens. But unfortunately, back then, in the early 30s, banks didn't necessarily, there weren't many rules governing what the banks could do. And so banks realizing, hey, we can make more money if we loan out some more money. So this worked for a while until the beginning of the Great Depression, until we get into the early 30s. And what's going to happen is people are going to start hearing rumors that, hey, did you hear American Union Bank? They're running low on cash. They don't have cash. And then that rumor starts to fly, and people decide they don't walk, but they run to the bank to get their money. And that's what you see in this picture. People are running to the bank to get their money. And sadly, as I said before, there weren't many laws governing banks and, the percentage of money that they could loan out. There weren't many laws. There weren't the necessary laws in place, I should say, to govern what they could do. And as a result, many people were hurt. As a matter of fact, beginning in the 30s, just per year, just over 1,000 banks were failing. They were failing because they ran out of money. They had no more money. And so what happened to the people who weren't able to have a chance to go and withdraw their money from the bank? Well, they lost it all. It was gone. Their money was gone. People who had life savings, the money was gone. And it's a very, very, very sad time in this country's history. As a matter of fact, in 1933, that was the peak of the bank failures. There was 4,000 banks failed. 4,000 banks failed. And I saw a number of up to, in the 1930s, there was over 9,000 banks that failed in the 1930s. 9,000 banks that failed in the 1930s. So you can imagine the number of lives that were affected by these bank failures. Now, let me take you back to the present. So here you go. Check this out. This financial institution, again, we're talking about crypto, but again, crypto is money, or it's kind of like money, kind of like money. If you can explain crypto to the audience, I challenge you to do so in the comments section. But just for lack of a better explanation, crypto is like money. Crypto has a lot of value. It has value. Okay. So check this out. Another crypto lender, because there's multiple ones that have done this. Another crypto lender, Vald, pauses withdrawals as market crash takes its toll. Now, Bitcoin, which is one of the major cryptocurrencies, Bitcoin was at, I believe it was like, the value was at over $60,000 per coin in November of last year. Now, as of today, let's check that out. Let's check out what crypto is selling at. Crypto is selling at $21,600 as of now. So the value of crypto has gone down. And what that has done is that has caught this crypto lender off guard. So they've paused their withdrawals as market crash takes its toll. Now, what does it mean to pause the withdrawals? Well, that's the same thing that the other banks were doing in the 1930s. They were saying, we're just closing our doors. We're going to close our doors and hide while the people are outside beating on the door, trying to get in, trying to get their money. So it's the same thing. It says here, crypto lender Vol paused withdrawals, trading and deposits on its platform, and is exploring potential restructuring options, the company said. So they're trying to figure out a way to stay in business, while you can imagine their customers are freaking out, wondering if they are going to get their money. Vol said it's facing financial challenges due to volatile market conditions, which has led to customers withdrawing more than $197.7 million from the platform since June 12th. Now, remember what I said before, financial institutions, they make money by lending out money. Now, in this instance, we're talking about crypto. And again, crypto is like money. So they're lending out crypto. But it says here, due to volatile market conditions, simply meaning that, whoa, crypto fell from over 60,000 a coin to now it's 21,000 a coin. Whoa, let me get my money out of that before I lose any more. So think of that. And like I think it's, well, I don't want to use the word interesting, but there are parallels, I should say. There are parallels, and that's the thing about history. We have that saying, in history, you learn from history, or else you're doomed to repeat it. And certainly it would appear that some of these crypto lenders, they were being a little bit too aggressive. Perhaps they were lending out too much money or crypto, and they weren't protecting themselves or protecting the business to make sure that they had enough money to cover the withdrawals, just in case the value of crypto dropped. Well, ladies and gentlemen, again, I encourage you to check out that video that I did about the Great Depression and the causes of the Great Depression, where I go into a little bit more detail about the financial institutions and how the collapse there really made life miserable for a lot of people, and it affected people in many different industries and different walks of life. So, ladies and gentlemen, I thank you so much for watching that, and until we meet again, please keep chasing the vision.